This is Debt Free in 30, where every week we take 30 minutes and get practical advice from industry experts about personal finance and living debt-free. Here's your host, Doug Hoyes.
It's time once again for our year-end review and New Year's prediction show. Every year we look at the trends we see in consumer debt and what it means for the coming year. Spoiler alert. The cost of carrying debt is going up faster than most people realize, so I don't think there's any doubt we have a looming debt crisis. To help decipher what's happening, I'd like to welcome back to the show Ted Michalos, my Hoyes Michalos co-founder and business partner. Ted, welcome back. Are you ready to pull out your crystal ball and tell us what's going to happen in 2019?
I didn't wear my Swami hat, but I'll take a risk and say some stuff.
Excellent. So here we go. Now, this is show number 226. Last year on show number 174, which aired on December 30th, 2017, we predicted that the consumer debt binge was likely to continue.
Did we use that word?
I believe we did. How did we do on that prediction?
We were correct.
Nailed it.
They just keep borrowing. All sorts of different metrics you can use, but most importantly, Canadians added roughly $85 billion in new debt, mortgages, credit cards, bank loans in the past 12 months. As of October, Canadians owe $2.16 trillion in debt.
That seems like a big number. So, okay, debt is up, but borrowing has slowed. So total consumer debt was up 3.5% in October 2018 over the previous year, which is the most recent stats we've got as we record this in December. But that's the lowest rate of growth in 30 years. So, okay, what's happening? Is debt going up? Is it going down? Is it slowing? What's happening?
Well, it's interesting. I mean, the way the media is presenting that is the way you just said it. It's the slowest rate of growth. It's still growing, but not quite as fast. I mean, an analogy that someone has used is you're driving the car at 120 kilometers per hour last year. This year, you're only driving at 100 kilometers per hour. Now, the thing I'd like to point out is that either one of those will get you killed when you hit the wall.
That's right. That's an issue. So, yeah, and if the population is going up by 1%, then total debt goes up by 1% just if everyone keeps doing nothing,
exact same thing. That's right.
So the fact that it's growing by 3.5%, you're right. It's still growing, and it's still growing faster than how the population is growing.
If you want to be morbid, if you had cancer, okay, it's not growing as fast.
Yeah,
I still got cancer.
It's still an issue. So
right.
Okay, so we're not growing as fast, and from the numbers, mortgages are the big reason. Mortgages make up most of consumer debt. That's not too surprising. In October, Canadians owed $1.5 trillion in mortgages. So obviously they owed like $624 billion in consumer credit, everything else.
Yep.
And it looks like mortgage growth is decelerating the most. So tell me about mortgage growth.
Well, so they are still growing, but it's a slower rate that they've been doing historically. The annualized pace of growth is probably one of the slowest in Canadian history. In fact, it is, right? Over the past 30 years, the rate of growth has fallen below 3.2% just twice.
April and May 2001.
You got them in the notes.
There you go.
That's right.
It's right here, yeah. And that was 17 years ago.
Right. And
so why is that? Why is the pace of mortgage growth slowing so much?
I mean, two major factors. The first was the change in the rules this year. So they've introduced the stress tests that it's making it more difficult, particularly for first-time buyers, to qualify for a mortgage. And the second, the real estate market in total has softened just about everywhere across the board.
Yeah, and so there's less demand for mortgages then. So now the numbers we're quoting, we're getting from the Better Dwelling website, so shout out to them. It's got lots of great stats, and I'll put a link to them in the show notes. So debt is still growing, but at a lower rate, and that's good, I guess. I mean, like you said, the wall is still coming up on us, but that doesn't mean we don't have a big debt problem on the horizon. So now a number that is often quoted in the media is the debt-to-income ratio.
Yep.
Okay, so the third quarter results came out in the middle of December, and those numbers also confirmed that Canadians' debt is growing. The seasonally adjusted debt-to-income ratio is now $1.78, up from the last quarter of just over $1.76. So what exactly are we talking about when we talk about the debt-to-income ratio?
Well, so for every dollar of disposable income that Canadians have, they actually owe $1.78 in debt.
Okay, so now our listeners are probably sitting there going, now, wait a minute. I thought that the debt-to-income ratio was just under $1.70 last year, so why are you saying it was $1.76 and now it's $1.78? What's going on? Well, Here's the answer, and this is not something that was initially reported on in the general media, so it's good that you're listening to today's podcast. The reason the numbers have changed is because the government changed the underlying numbers. The income number in the debt-to-income ratio comes from Canada Revenue Agency, and of course, CRA knows how much money everyone makes because it's on our tax returns. And the new numbers show that Canadians are not earning as much as we originally thought. This seems like a problem to me. So we know debt is going up, but if income is not going up as much as we thought, that makes the debt-to-income ratio worse than originally projected. They went back and revised the numbers, and since the beginning of 2016, the debt-to-income ratio was revised upwards by an average of about 3.5 percentage points a year. So does that surprise you?
Oh, it doesn't surprise me at all. We've been worried about Canadian consumers' debt levels now for years. Our concern has always been that people can't afford the payments. And now what we're discovering is that the income has been overstated and, in fact, they can't afford the payments.
Yeah, so it's exactly what we're seeing on the street. So if you have less income, that means less money to repay all of the debt. And, of course, that's the problem. Debt is becoming less affordable, and that's what's always worried us. Now, here's one more scary fact. We are now consuming more of our income on debt payments than we have in the past. The debt service ratio has gone up from 14.08 to 14.51 over the last year. That means that Canadians are now spending 14.5% of their income on interest and principal payments. Now, we've been saying for years that debt is a problem, but the pundits have said, don't worry, interest rates are low, we can afford it. The impact of rising interest rates is showing up in our finances loud and clear. The total interest paid by Canadians, and this to me is the most amazing stat in this whole show, and we got lots of stats, but the total interest paid by Canadians has gone up by 15% in the last year. 15%. Now, to me, that's huge. What's going on here?
Well, I mean, it's simple math, folks. You have $1 to spend. If your debt servicing costs go up 15%, that means you got 15% to spend less on something else. And when interest goes up, you have to pay more. You should all be terrified.
Yeah, we can't afford it. So now that's total debt.
Right.
So let's be a little more specific and talk about mortgages. So non-mortgage interest, so obviously everything other than a mortgage, credit cards, bank loans, whatever, is up 16%. Mortgage interest being paid is up 13%. So last year on this show, you predicted that mortgage rates would go up. Well,
congratulations.
Pretty much you were right on that.
I get a free mug.
You get a free mug. So, okay, tell us about mortgages. How much have they gone up? What's happening?
Okay, well, so let's look at some hard numbers. That's easier for people to understand. According to Rate Hub, the discounted 5-year mortgage rates, that's the rates not posted by the bank.
So a real rate,
right?
What you'd actually pay.
So November of 2017, 2.69%. So that was a good customer for a first mortgage. November 2018, 3.34%. That's a 0.65% or 65 basis points increase. That makes a huge difference on every $100,000 that you owe. It's also, let's go back to 2016 when it was 2.09%. So that's a 1.2 points.
Yeah, that's a huge number. And I know we've talked about this on this show before, but a lot of people still don't grasp this. Mortgage rates, like you said, they were just over 2%. 2% interest rate a couple of years ago, and now they're up to like 3 1/3. And again, we're talking prime customer. So that's up 1 1/3 points, which doesn't sound like a lot. Okay, 1.3%. Who cares? Not really a big deal, but it is a big deal.
It's a huge deal. So you're comparing 2% to now 3.34. So that's an increase of 65% in the interest rate. Did your pay go up 65%?
That's a good question. How many people, raise your hands out there on YouTube, had their pay go up by 65%? And the answer is not many people, probably nobody. So, and I know, okay, people are listening going, okay, you guys kind of are picking the most absolute worst case scenario, the absolute peak and bottom. And okay, and sure, we are doing that. But, and so that absolute number may not be a relevant comparison for everyone, but and it's true. Maybe your mortgage isn't up for a renewal, or maybe you locked in for 5 years or something. But how many people have a HELOC, home equity line of credit, or a variable rate mortgage, Well, the answer, I think, in 2018 was over 40% of mortgages reset this year.
Correct.
Either because it's a variable rate or it was coming up for renewal, which means it'll be roughly the same kind of numbers next year. That, to me, sounds like a bit of a killer.
Oh, it is. Again, because you haven't got any more money coming in. What is it? HELOC's hit $292 billion in September of this year.
So that's almost $300 billion.
Folks, and we're using jargon here. That's a home equity line of credit, in case you're, not familiar with some of this stuff. So if you had a $50,000 balance on your line of credit and it was 2% monthly payment, it just went up by $83.
$83 a month
on that one debt.
On that one debt of $50,000. So if your HELOC is a couple $100,000, obviously you're looking at $150, $200 or whatever that is going up.
Well, you can use the same math on a first mortgage too, right?
Yep.
So,
yeah, I mean, if you've got a $400,000 mortgage amortized over 25 years, every quarter point is about $50.
Right.
And
so your $50,000 example, $400,000 mortgage. I mean,
it's roughly the same kind of numbers.
$640.
Yeah, and it's okay. So it's gone up, but it's now gone up every month, month after month after month after month.
Right.
That's where the killer. So a HELOC, as you said, a home equity line of credit. So, and we've seen this in our business a lot.
They have. Yeah.
People come in to see us and they've got, $50,000 worth of credit card debt, but because their house has gone up so much in value, they can go to the bank and say, hey, can I borrow that money against my house, pay off my other debt?
That's right.
Is that what we are typically seeing with people? And is that what they're using their HELOC money for? Is that what they're borrowing for?
I don't know if it's the principal thing that they're borrowing it for, but it's certainly one of the big things. And it's only because they've been able to tap into it, because interest rates are lower on a home equity line of credit, and they've had this equity in their house. I mean, from the Ted Michalos Homeowners Bankruptcy Index, November of 2017, 7.9% of our clients that filed bankruptcy or a proposal owned a home when they filed. Last month, that's down to 5.2%. But if you go back to 2011, it was 34%. So, I mean, it's people are tapping into that because they can right now. And I think that window's closing.
Yeah, and it's not showing up in the, like you said, the Ted Michalos Homeowners Bankruptcy Index yet, but we keep a track of that every month. And again, I'll put a link to it in the show notes. We put that right on our website. So there's lots of people in the media who follow it. You can certainly follow it as well. What that really means in layman's terms is if you own a house, you're not filing a bankruptcy or a consumer proposal.
You've been able to refinance for at least the last couple of years.
Because the house price has been going up. So even if your debts have been going up, it hasn't mattered because house prices are going up. So your worry is what happens if house prices don't keep going up?
Exactly. I mean, we're seeing more people with houses. I can tell you that anecdotally because they can't borrow anymore. The market has softened. They've already used the equity trick once, whatever the reason is. They can't tap into that number anymore, and that's making a big difference.
And that's a key point you're raising there. It's not that they don't have equity.
Right.
It's that they can't get it.
Right.
So you're seeing the banker is saying, well, okay, you got $100,000 in equity, but because of the stress test, because of your income, whatever.
Because of the rules that are in place, we just can't give you access to it. Now, sometimes they're saying, well, why don't you go see somebody for a second mortgage? But second mortgages are always a dangerous idea. I mean, the interest rates are higher, and you're trading one problem for another.
So the banks have tightened up. They don't want to take on the risk going forward. So your comment about things might be getting softer in the future, okay, the banks are seeing it already. That's why they're tightening up. So, well, and I know, I mean, this has happened to me 2 or 3 times over the last couple of months. I'm talking to a guy who has a line of credit. I'm not even talking about a HELOC, not a secured line of credit secured by the house, but just a normal garden variety line of credit. And, last year the interest rate was 5%, but a couple of months ago the bank said to him, oh, guess what? It's now 10%. Yep. Why would the bank bounce his interest rate up that much? Risk, right?
Right. Well, I mean, they do it because they can, because you sign something saying that you're going to pay a variable rate and it's subject to market conditions. And if the mortgage rates have gone up 1.3 full percentage points, or 65% in the last 2 years, then a regular line of credit interest rate is going to go up that same amount.
So how does that impact on consumer insolvency levels? So before we get to the prediction section of the show, what's happened with consumer insolvency levels in Ontario so far in 2018. And we've got numbers up till the end of October. The government's always a couple months behind, so we don't have the full year yet.
But at the end of October, they're up, it was 0.1% in
yeah,
Ontario?
It's just under 1%.
Yeah.
But they've been up, I think it's like 0.6% if you look at Ontario, but they've been up 5 of the last 7 months.
That's right.
So, okay, they were down earlier in the year. Now they're starting to come back. So that's a potential warning sign. Okay, so we've got a good picture of what's been happening and why it's been happening. So now it's time for predictions. So what do we see for 2019? So first up, let's talk interest rates.
Yep.
So everyone watching this show knows they've gone up 25 basis points. That's 0.25%, 5 times since July 2017. Are we going to see more interest rate increases coming?
Yeah, I hate to say it, but by the end of 2019, we'll see at least 75 more basis points. So another 3 times it's going to go up that 0.25 point.
If they do it by 0.25 point. Okay, so and if I had to predict, I'd say that sounds reasonable. Who knows? It could be more or less than that. So,
but that means we'll have gone up 2.5 points in 2 years.
And we were starting at like
2.09. Yep.
So that's more than double, isn't it?
Yep.
If I'm doing the math in my head here. So you are predicting that by the end of 2019, an interest rate. Well, let's talk about mortgages.
Well, let's be simple. Yeah, in 2009 it was 2.09. We're saying by the end of 2019,
2016.
Yeah, right. It'll be 4.
Yeah. So more than double. And so if all I'm doing is paying interest, I'm paying twice as much then.
Correct. And if particularly anybody in a new house, that's exactly what you're doing. You're not paying down your capital. That bill every month is interest.
So what impact is that going to have then if interest rates are going up on, mortgages, which are the biggest component of our debt? Obviously, they're going up on everything else. I mean, maybe they don't go up on credit cards because they're already at 20%.
Yeah, the credit cards don't fluctuate the same way that mortgages do.
Well, a standard one doesn't, but if you've got a low interest credit card, those are the ones that bump up. So we already said that so far in 2018, the rate of consumer proposal and bankruptcy increase has been relatively flat, half a point. What is your prediction for 2019? How much, well, first of all, do you think the rate of consumer insolvencies will go up? Because it's been going down for 8 straight years. Yeah. 2018 will be the first year where it's either flat or a little bit up. Is it going to go up next year?
Yeah, I don't see how it can possibly be flat. I mean, all the indications between the interest rates and other costs of living going up, consumer insolvencies are going to go up. You want to be...
Give me a number. What's
the real
the number?
Doom and gloom
What's
guy?
the number?
Somewhere between 8 and 10%.
8 and 10%. Oh my goodness. 8 and 10%. He says they're going to go up.
He's smiling at me because he thinks I'm being I'm not overstating it. I think that's what it's going to happen.
Yeah, and if I had to predict, I would say, well, I don't think it's going to go up that much. But I can certainly paint the scenario where it does. I mean, even if it went up, what did you say? 8 to 9, 8 to 10?
8 to 10, yep.
So even if it went up 10%, that would only put us back to where we were in what? 2015, 2016. I mean,
we'd be nowhere near the peaks.
No, we'd be nowhere near the peak. So, I mean, we are 40% less than where we were at the peak. So even a 10% increase, and I realize you're dealing with different bases, so it doesn't make sense. But, I would not predict that much.
Right. But you've always been more positive than
I know. I'm the happy-go-lucky guy here. So, but, could I see a 2, 3, 4, 5% increase? Absolutely, I could. And if interest rates keep going up,
and they're going to,
then boom, it's like rolling a ball off a table. It's going, and then boom.
And I think the only thing that's stopped them increasing this fall is that fuel prices dropped again. I mean, the big problem this spring was gas prices went through the roof. You were suddenly paying $1.45 for premium, which everybody's putting in their new cars. It's dropped back down to $1.18. That's relieved some of the pressure, and they're going to go back.
Well, and I drive an old car that doesn't take premium, and I think I'm paying $1 or 95 cents or $1.05.
The new one plugs in,
that.
so
yes, that's right. If they plug in, then you're good. So, a 10% increase would imply perhaps that we're now into a recession.
I don't directly tie consumer insolvencies to the economy that way. Because what we experienced with this last economic boom, for lack of a better term, was the economy got better, but lots of people were left behind. And so I think that what we're going to experience first is all those people that got left behind aren't going to be able to deal with the squeeze. So they're going to be the ones that fall off the ledge first. Now, that might drive a recession. I could make that's a good argument. But the one doesn't necessarily follow the other.
Yeah, and you can get into debt problems even if you've got a job. In fact, that's all of our clients, or most of them.
That's right.
It's my debt is growing, or it's not the debt, it's the cost of carrying the debt. That's
Correct.
kind of the point we're trying to emphasize here.
And I mean, because we see people at every income level. So the folks that actually take on the most debt are the ones that think their income is going to increase. So they anticipate it and they start to spend differently. And when those realities don't come about, or the cost of servicing that debt gets too high, they got to come see us.
Yeah, if you've never had a job and never had any income, then you probably don't have any debt.
Yeah.
It's the future. I think my things are going to get better. I think I'm going to get a raise at work, so I start accumulating debt now. So it's if that anticipation turns into the opposite, things are starting to get worse, then I'm not borrowing for the future. I'm borrowing to survive, and that's where it can really, really collapse.
I mean, if you want to steal from the headlines, we've got all the uncertainty in the U.S. We've got the uncertainty in Brexit. We got whatever the Chinese are doing. There's lots of reasons that somebody could predict a recession right now. I think the consumer debt prices contribute to that problem as opposed to the other way around.
So we're not economists, even though we obviously play them on these podcasts here.
Right.
And our job is not to advise the government or corporations or anything like that. We'd be happy to take millions of dollars from them if they wanted to, but they're not calling us. Our job is to advise individual people.
Correct.
So final question to you. If your prediction is right, even if it's wrong, the cost of servicing debt is going to go up.
What if I'm only half right? It's still horrible.
It's still a big problem. So, okay, what is your practical advice then for someone who's listening to us right now who's sitting there going, well, okay, yeah, I could, I guess, lose my job or get my hours cut back, or even if I don't, the interest rate on my line of credit is probably going to go up. It's going to cost me more. So what should I be doing right now at the end of 2018, at the beginning of 2019 to set myself up for 2019?
Debt problems do not go away. You've got to deal with them. So the best advice we can give everyone is if you can't deal with them with yourself, reach out to somebody like ourselves, like your banker, like a credit counselor, someone who's qualified to help you so you can analyze the problem, figure out a plan to become debt-free.
And so analyzing the problem starts with adding up what you got.
Yeah, you got to start with recognizing the problem. So make a list. These are all of my debts. So I've got my mortgage is at 3%, but it's going to renew this year, probably at 4%. I've got a home equity line of credit. I've got 3 credit cards. So I'm going to owe $5,000 when I file my taxes this year. Become aware of what the problem is. That's the first step to getting your hands around it and solving it.
Yeah, and I like the term stress test, which of course is what bankers do, but that's really what it is. So I've got my line of credit right now, and the interest rate is whatever. Let's say they're charging me 5%. Well, what if it went up? Your prediction is 75 basis points. What if it went up to 5 3/4, 6%? You can do the math pretty easily. How much do my monthly payments go up? How does that affect me?
Right.
And if the answer is, you know what, I'm already on the edge, I cannot afford anything more, then that's when you got to reach out and deal with it.
And statistically, Equifax, TransUnion, all of those credit reporting agencies are telling us that people are on the edge. That's what that $1.78 of debt versus income means. For every dollar you earn, you owe $1.78 in debt.
Yeah, it's a big issue. So that's the starting point for 2019. If you've got debts, then they're not going to go away on their own. Reach out and deal with them now.
Right.
Excellent. Ted, thanks very much for being here. We will reconvene in a year and see if your prediction of a 10% increase in consumer insolvencies ends up coming true. So that's our show for today. This show is our most researched show of the year. Not to say that we don't put in research into our other shows, of course. And I do like to show our work. So I'm going to put links to all of the research that we quoted today in the show notes over at hoyes.com. That's HOYES.com, where we've also got a full transcript of today's show and a link to our YouTube Debt Free in 30 channel so you can watch the video of all of our shows and see what it's like behind the scenes. Thanks for listening. For Ted Michalos, I'm Doug Hoyes. That was Debt Free in 30.